presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Welcome everyone to this weekly edition of the Compact YouTube channel. I'm your host this week, Javaid J. Ansari, Executive Vice President here at Compact Asset Management, filling in for your longtime host, Mo Ansari. We're giving him a little bit of a break this week, so temporarily just filling in for him this week on the YouTube, but we'll be going through all of the market action from last week and then previewing what we expect this week. So once again, thank you for tuning into the YouTube channel this week. As always, if you'd like to get this communication from Compact directly to your inbox, just go to our website at compact.com. Click on Insights. You can put in your email. Very easy. And then every week you will get notification whenever we do post a new podcast or YouTube to the channel. Also, if you want to interact with us, we encourage any sort of questions or inquiries, direct those to invest@compact.com or just give us a call, 800-388-9700. Looking at the markets last week, we had the S&P down slightly, just down 0.08%. The Dow Jones down 0.11. Russell still showing a little bit of relative strength that we've seen over the last couple of weeks, up 0.22. The overall growth slightly at 0.04. Value down 0.11. International take a little bit of a beating last week, down 1.43. We'll talk a little bit about more of that. Emerging markets down a little bit, and then the NASDAQ flat. But still, overall, this is what you need to focus on. Markets still up 11% for the year, and this is on the back of just incredible returns that we had in 2024 and 2023. Now, though, we are entering seasonally a weak period time in the market. September and October, particularly to the middle of October, can see a little bit of a pullback. And I think going into this market, into September and October, we really wanted to see what were some of the main indicators telling us. And one of the things we were going to watch was NVIDIA. And that was a big announcement last week. NVIDIA came out with their earnings in the middle of the week after the close on Wednesday. And by all accounts, the earnings were fantastic. Both beat on top line in terms of revenue, beat on the bottom line in terms of profits. When you look at the guidance was all looking really good. The little thing, if you really wanted to nitpick it, was the fact that their data center revenues were not quite as what the Wall Street was expecting. Well, okay, maybe there is a little bit of a slowdown in AI investing, etc. But AI investing is still very much a huge part of this economy going forward. Now, the key thing was not so much the earnings. We were expecting those to be great. The thing you have to look at is the reaction. And if you look at the market reaction of NVIDIA, it was actually down on Thursday, down on Friday, and then continuing to consolidate here on Tuesday. Happy Labor Day to everyone. Hope everyone had a great long weekend. But when you start to get good news, such as blowout earnings and in line with expectation, and then you start to see stock prices decline, what that starts to tell you is the market is fully priced. All the good news that we were anticipating with all of this earnings, if you look at the Q2 earnings in general, it more than met expectations. Beginning of the year, expectations were for Q2 earnings to grow by about 11%. Those expectations were drawn down to 4% as we went through the whole tariff tantrum. But ultimately, the earnings did achieve that 11% growth rate. And the interesting thing is if you dive in and look at those earnings, it is the Mag 7 that are still driving almost, if you look at the earnings growth, 22% of that earnings growth, 22% is the growth rate of the Magnificent Seven versus only 12% for the other basically 493 stocks. And so that just tells you how powerful the tech industry is and going to continue to be to really fueling this market forward. I think now if you look at the S&P 500, almost 39% of the entire S&P 500 is just the technology sector. So we're going to live by this tech sword, we're going to die by the tech sword. And so NVIDIA gives us a little bit of an indication that maybe we are due for a little bit of consolidation within the stock market. And that's what we've been talking about, both Mo and I, on both the YouTube and the podcast for the last couple of weeks. So I think stay tuned as we kind of see what transpires here over September. Usually this is actually, if it's seasonally still a bull market, September and October can be a great buying opportunity for that fourth quarter, the old Santa Claus rally that comes towards the end of the year. So stay tuned. We'll go through some of the indicators and things to watch for when we look at the charts in this week's edition of the YouTube update. And so we'll see how that all plays out. Looking at sectors last week, energy was up big, up 2.5%. Utilities and consumer staples down for the week, down 2% and 1.7%. Consumer staples and utilities, when you look at the earnings, those are the ones that saw the most multiple expansion. Weren't really, their prices went up, but it wasn't really kind of driven by a lot of earnings growth, which you never really expect from consumer staples or utility companies. And so a little bit of the air coming out of the balloon in those particular sectors, but overall very positive. I think one of the other things that we're starting to really take a look at is this little kind of sector down here, healthcare, has been really flat for the year. I think beginning to maybe trim, or as Mo likes to call it, prune and plant some of your big earnings from the tech companies, if we are going to see a little bit of consolidation there. And I would be taking a good look at healthcare, because I think that's going to be something that is going to be integral, I think, for a long time going forward. Oil prices actually down nicely last week, so I think oil is overall. I will show you a long-term oil chart in today's YouTube. You're going to get my version of the charts. I know Mo has his in terms of the Elliott waves and everything else. I tend to look a little bit more, longer-term trends, Bollinger Bands, and some gaps. So we cover all of the technicals here at Compaq. So I'll be showing you a little bit more on the oil index later. Also nice to see, high yield still trending up really nicely, 0.45% compared to the ag only up 0.16%. Today, we saw rates kind of spike a little bit. There is some concern, I think, starting to bubble up that, there's maybe some worries about a debt crisis in France. It used to be Italy, now it's France. Japan has a lot of debt. We're seeing there basically some inflationary pressure there and interest rates going up. So those are kind of some international markets. I think that's also why international was down so much last week, as there is some worries about their overall kind of fiscal stability. So we'll continue to watch that. It's a big reason why we've said, when it comes to international investing, still wait and see before you're really making those big strategic shifts from U.S. to international. Because of this debt situation, it tends to pop up. And if you look at the earnings of European companies, I just talked about the earnings of the Magnificent Seven, the earnings of the European companies have been zero. And so, still a lot of that earnings growth is coming from the U.S. companies, and that's ultimately, as Mo talks about, the mother's milk of the stock market is earnings growth. So you want to be investing where you're seeing that earnings growth and not really seeing it in Europe. So that's kind of one thing we're watching in terms of interest rates abroad. I think also interest rates at home are also important to watch as well. And if you look at the 10-year Treasury at 4.23, I'll show you my chart looking at the 10-year. Saw a little bit of a spike today. I think that's causing a little bit of the air to come out of the valuations on the stock market. But I think that's going to be very important to watch, because as we get into the Fed announcement here in the middle of September, you couple that, are they really going to cut when PCE and PPI numbers are at 3% and their target is 2%? They're quoting maybe we're seeing some job employment and the job market is weakening with that July number. That's going to be the big data this week. We get another update on the employment number, the jobs number. It's expected to be about 100,000 jobs. But if you look under in the details of those job numbers, it really has been just more of the job demand. Companies are just not demanding as much new jobs as there is maybe companies laying people off. Laying people off is that sign, okay, we're in a recession, it's game over. The job market still seems pretty tight and still looking pretty good from our perspective when you look at the details, yet the Fed is kind of now starting to say, hey, we need to be cutting rates because of that. That could be a slippery slope. I think if you start to unhinge a little bit of those inflation expectations, You couple it, maybe also the big news last week was with the tariffs, those being potentially overruled by the federal court. Most likely it's going to go to the Supreme Court. Right now it's on pause till October 14th. But if the tariffs are revoked, that then means the Treasury potentially has to repay all of those tariffs being paid. That puts more stress on the deficit. And then the final piece, and I think this is also going to be really important, is the Republicans coming back from their summer vacations. One of the things of the OBBBA Act that was part of basically extending these tax cuts was also pulling back subsidies for Medicare and medical premiums. Well, this would be one of the first times I think government goes after actually cutting entitlements. And typically that doesn't bode well at the box office, or in this case, the voting box in the midterms, if people's premiums are going up substantially starting January. And I think one of the things they're going to try to sneak in before the end of the year is trying to get that additional spending to maintain those subsidies in place. And that is also deficit fueling. So then you put all these things together: lack of tariffs, potential Fed cut, maybe more subsidies around healthcare premiums. That is all a recipe for potentially a higher deficit and then potentially higher interest rates. And if we do start to see higher interest rates, I think that could be a catalyst for a good sized correction from these valuations that we're seeing in the stock market today. So not making that call today, but I think it's one of the themes that you'll see Mo and I evaluate as we kind of continue to watch, particularly this 10-year Treasury market over time. For the chart of the week, we're just showing AI uprising. If you look at how much basically investment and consumer spending is fueling GDP right now, it's about 45%. It's hard to pinpoint exactly, but 35 to 45% of GDP is being fueled by AI spending. Now, are we going to start running up against some energy constraints around AI? I think so. And so we'll see if they're going to be able to still invest at this particular level and fuel GDP. If we didn't have this AI investment, GDP would be 1% this year. And that's, I think, something to just continue to watch. So far, so good, but definitely something that we're keeping an eye on, because as you get narrower and narrower in the amount of basically market participants that are pushing the stock market, that's when things can get a little dicey. You can see some larger corrections. Looking at last week's economic news, home sales rose to 652, beating estimates. So as interest rates have really been in a range here, I think that's starting to see buoy the housing market a little bit. But prices have been coming down in both the West and in particularly Florida for the last year or so. Consumer confidence is still kind of meandering. And I think the big one is still PCE is averaging out to around 3%. This week, we'll be looking at ISM numbers, particularly manufacturing ISM numbers have been down for the last 5 quarters, I believe. And so manufacturing, with tariffs and the uncertainty there, has been difficult. I think it's also interesting to note that the Fed, if you look at it historically, has never cut interest rates when input prices are going up. And that's actually what we've seen. So if input prices continue to go up for manufacturing, the Fed's never cut rates. And so the Fed's playing, I think, in our opinion, a dangerous game if they are looking to cut rates when we haven't quite completely squashed the inflationary bug yet. So something to watch here going forward. ISM plays into that. And then, of course, the jobs number will be coming out on Friday. But I'm also just kind of interested to watch, now that we've kind of digested all of the earnings, NVIDIA came out with this earnings, now that majority of people are back into school, back to their offices, the institutional traders are, maybe back from vacation after Labor Day, you tend to see some trends here reemerge like you do at the beginning of the year in January. And so if we continue to see some weakness, I think, in the stock market, which I think is kind of our base case here through September, kind of really categorizing that weakness and whether this is a buying opportunity or the beginning of some bigger correction is something we're going to be watching here throughout the month. So diving straight into the technicals, a little bit of different feel here on the weekly edition of the Compact YouTube. These are my particular charts. I tend to have a black background. But you'll see I have a lot of these basically red lines going down all the way. And this was the lows that we saw back during the tariff tantrum in middle of April. But these red lines, what each one of these represents is gaps. You can see here a gap in June of this year on the stock market. And the reason I mark those on my charts is because the market is ultimately a price discovery machine. And I believe that some of these gaps that form overnight are basically air pockets in the stock market that typically tend to go back and get filled. Now, do we go back and fill them now? Hopefully not. Maybe we fill them in a couple of years from now, but there's no set rule that we need to go back and fill them. This is a daily chart. I have some gaps going back even further down. But I do think it does give us some just kind of maybe some inquiry into what might be happening potentially over this potential correction that we're maybe beginning to experience over the last 2 days here in September and October. And I think my overall piece is that I think we could get all the way down to almost 6,000 and fill this gap here, which is the mid-June gap on the S&P. That'd be a correction around, I want to say around 7.5%, which would be a pullback is 0 to 5, corrections 5 to 10. So I think we'd be in that correction territory if we get down to 6,000. That also tends to dovetail with that purple line there, which is the 200-day moving average. So we'll see how this all plays out. This is where we're at 63.98 today. You can see I turned this one is white. That's a gap that we filled, and there's been a lot of gaps here since the middle of July and August. So I think that might be some areas that we're looking at on downside is filling some gaps here going forward. So does that mean you go out and sell all of your stocks? No. Have we been talking about rebalancing and putting some protection in potentially? If you have concentrated stock positions, now is a good time to maybe collar them, put some downside protection on those. Hopefully they've appreciated a lot, because if the overall stock market is going down, those concentrated stock positions can go down further. I'll skip the NASDAQ this week. I'll go straight to the 10-year Treasury. And I think this is one of the most important charts to watch, because the stock market, yes, we've seen it inflate a lot, but I think also you're going to see a correction, a bigger correction or move if we see interest rates break out. And we can see here, I've drawn a triangle. As you see this yellow line going here, and you can see this bottom yellow line going here. And basically it comes out anywhere at around 3.8% or 4.7%. I think as long as we remain in this range, we're basically in kind of a very tight range. You can see this chart goes all the way back basically here to the middle of 2023. And so I think going forward, it's going to be important to see exactly what's going on in terms of, it looks like I turned on my subtitles. I don't know how to turn that off. There we go again. So then we'll have to really watch and see where this chart goes. If we do break out below 3.8, I think that's a sign that we're going into a recession. If we break above 4.7, which I think is the potential place of where we could go above, the most likely case, given all of that deficit spending I just outlined, I think that's going to be a great opportunity to potentially reallocate into bonds. We don't want to get above this 5.2. I think that's the ultimate level where we'll see a bigger correction or a bigger recessionary type of correction in the market. But as long as we kind of meander through this range here for a period of time, that's all very positive. And really just, we have to wait and see for a breakout in the 10-year before you have confirmation signals that you have to be making more larger strategic moves in your portfolio. Gold, also a big breakout today. I think a little bit more of the uncertainty around the tariffs going forward. Saw a big breakout in gold today. We've talked about how gold was in basically a tight range here since middle of May, and finally we're experiencing the breakout back to the upside. So I think as more of this uncertainty kind of comes back into the market, are we at a high? Are we not? What is the Fed going to do? What is the deficit going to do? Gold then starts to continue that resumption to the upside. This is a DBO chart. This is looking at the futures on crude oil. And I did a long-term chart here. This actually goes back all the way to 2009, 2010. You can see Treasuries, oil prices were basically in a range here for quite some time, for also from 2009 to 2015. Then we saw a huge drop here from 2015 and 16. This was due to fracking. Fracking basically fundamentally changed the global supply of oil going forward. And then we were in a range here for quite a time. Basically the top of the range and the bottom of the range are outlined by those two blue lines. We broke out temporarily during the the initial onset of the Ukrainian situation. And since then, we've been just kind of hugging the upper end of this range. I ultimately believe that oil prices want to go back down to either the middle of this range, which we kind of got there a little bit earlier this year, potentially the bottom of the range going forward, particularly as oil, we slowly but surely diversify, get some more renewables, get some more sustainability within the global economy. I think there's just going to be less pressure on oil. And so my overall trend is oil is going to continue to the downside and then get back into those ranges similar that we saw back from 2016 to 19. So I think there's this downward deflationary pressure on oil when you're looking at the charts. And I think that's overall good for economies going forward. Cheaper oil helps everyone. Looking at a little bit of Bitcoin here, Bitcoin has been somewhat of an indicator. We kind of saw this shooting star chart, basically candle here, and then we've since reversed down. And then basically since that time, the NASDAQ, we've seen that rotation over the last couple of weeks out of the NASDAQ into even the Russell and other S&P 500 companies. So I think you can use Bitcoin to kind of assess a little bit of that overall correction and rotation. Seems to be on a little bit of a consolidation. I'm not incredibly bullish on Bitcoin or necessarily Ethereum just because of the overall stock valuations. I think last time we saw a big correction in Bitcoin was in 22 when we saw those interest rates go up dramatically. We're not going to see the percentage gains in interest rates, but if we do see interest rates go up a good amount, that could definitely, I think, impact some of these more speculative pockets of the market. I think Bitcoin, Ethereum, some of the go-go stocks, those are the things that are going to be most impacted. So you got to be, I'd say, be a little bit wary of adding a lot of Bitcoin at these prices. And then finally, one of my favorite indicators, my recessionary indicators, the high yield bond ETF. You can see here, I have a yellow at 78, I have red at 75. So we're way above the yellow. This is the cautionary zone. We break below 75. We were there for a little bit. That also coincided with the low that we had back in 2024. Don't want to break that. We break that, we're headed towards a recession. But of course, we'd have to get through 78 first. So I think as long as we're above 78, we've been trending up, definitely gap down a little bit lower today. But as long as we're above 78 on the high yield bond chart, I think you're still, the recession is a little ways off, and there'll be things that we'll be watching here on Market Wrap going forward. That's it for the week. So hopefully you enjoyed that different flavor of the Compact YouTube this week. Any comments, questions, just feel free to shoot them our way at invest@compact.com. Give us a call at 800-388-9700. Please do visit our website at compact.com. Click on Insights, put in your email, and you'll get notification of these updates to hopefully be your signal through all the noise. These are our disclosures as always. And with that, I'd bid you farewell and look forward to speaking with you again next week. Until then, good trading.
This presentation contains the current views and opinions of Moees Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.